Hello and welcome to today's episode which deals with banking management. Student, this is really interesting and important topic. We have discussed this in phase 1 and now we will discuss the details of it in phase 2. Well, to understand and take advantage of the same, let's first understand what we had already discussed in previous episode of bank management part 1, as it will be a revision for those who have gone through it and information for those who are viewing this for the first time. As a practice, let's first understand few important terms. A bank is a financial intermediary that accepts deposits and channel those deposits into lending activities, either directly by loaning or indirectly through capital markets. A bank links together customers that have capital deficits and customers with capital surpluses. Well, before we move any forward, I would like to give a quick introduction about myself. I am Ms. Pallavi Mohan, currently working in an MNC, have worked over 16 plus years in management, marketing, strategy and various other sectors. I have worked in 2 countries and studied in 3. Companies where I have contributed are many: Cafe Coffee Day, Sports Station, Nike, Levi's, Dockers, Eigner, H2O Plus, Royal Orchid Hotels, Reliance NIS Sparta, Philips, Starbucks, Target, Sloman, Dunkin' Donuts, 7-Eleven and Britannia. Due to their importance in the financial system and influence on national economies, banks are highly regulated in most countries. Most nations have institutionalized a system known as fractional reserve banking, under which banks hold liquid assets equal to only a portion of their current liabilities. In addition to other regulations intended to ensure liquidity, banks are generally subject to minimal capital requirement based on an international set of capital standards known as the Basel Accords. Assets of the largest 1,000 banks in the world grew by 6.8% in the 2008-2009 financial year to a record $96.4 trillion, while profits declined by 85% to $115 billion. Growth in assets in adverse market condition was largely a result of recapitalization. EU Bank held the largest share of the total 56% in 2008-2009, down from 61% in the previous year. Asian Bank shares increased from 12% to 14% during the year, while the share of US Bank increased from 11% to 13%. Fee revenue generated by global investment banking totaled $66.3 billion in 2009, up 12% on the previous year. Commercial banks, the term used for a normal bank to distinguish it from an investment bank. After the Great Depression, the US Congress required that banks only engage in banking activities, whereas investment banks were limited to capital market activities. Since two no longer have to be under separate ownership, some use the term commercial bank to refer to a bank or a division of a bank that mostly deals with deposits and loans from corporations or large businesses. Community banks, locally operated financial institutions that empower employees to make local decisions to serve their customers and the partners. Community development banks, regulated banks that provided financial service and credit to underserved markets or populations. Land development banks, the special banks providing long-term loans, are called land development banks, in short LDB. The history of LDB is quite old. The first LDB was started at Jung in Punjab in 1920. The main objective of LDB are to promote the development of land, agriculture and increase the agricultural production. The LDBs provide long-term finance to members directly through their branches. Credit unions or cooperative banks, not-for-profit cooperatives owned by the depositors and often offering rates more favorable than for-profit banks. Typically, membership is restricted to employees of a particular company, residents of defined area, members of a certain union or religious organizations, and their immediate families. Postal saving banks associated with national postal systems. Private banks that manage the assets of high net worth individuals. Historically, a minimum of 1 million USD was required to open an account. However, over the last years, many private banks have lowered their entry hurdle to 250,000 USD for private investors. Offshore banks locate in jurisdiction with low taxation and regulation. Many offshore banks are essentially private banks. Saving banks in Europe, saving banks took their roots in the 19th or sometimes even in the 18th century. Their original objective was to provide easily accessible saving products to all strata of the population. In some countries, saving banks were created on public initiatives. In others, socially committed individuals created foundation to put in place the necessary infrastructure. Nowadays, European saving banks have kept their focus on retail banking, payments saving products, credits and insurance for individual or small and medium-sized enterprises. Apart from this retail focus, they also differ from commercial banks by their broadly decentralized distribution network providing local and regional outreach, and by their socially responsible approach to business and society. Building societies and land banks, institutions that conduct retail banking. Ethical banks that prioritize and transparency of the operations and make only what they consider to be socially responsible investments. A direct or internet only bank is a banking operation without any physical bank branches, conceived and implemented wholly with network computers. Investment banks underwrite, guarantee the sale of stock and bond issues, trade for their own accounts, make markets, provide investment management and advise corporations on capital marketing activities such as mergers and acquisitions. Merchant banks were traditionally banks which engage in trade finance. The modern definition, however, refers to banks which provide capital to firms in the form of shares rather than loans. Unlike venture capital firms, they tend not to invest in new companies. Universal banks, more commonly known as financial services companies, engage in several of these activities. These big banks are a very diversified group that, among other services, also distribute insurance. Central banks are normally government-owned and charged with quasi-regulatory responsibilities such as supervising commercial banks or controlling the cash interest rate. They generally provide liquidity to the banking system and act as the lender of last resort in the event of a crisis. Islamic banks adhere to the concept of Islamic law. This form of banking revolves around several well-established principles based on Islamic canons. All banking activities must avoid interest, a concept that is forbidden in Islam. Instead, the bank earns profit markup and fee on financial facilities that it extends to customers. The United States banking industry is one of the most heavily regulated in the world, with multiple specialized and focused regulators. All banks with FDIC insured deposit have the Federal Deposit Insurance Corporation (FDIC) as a regulator. However, for soundness examination, that is, whether a bank is operating in a sound manner, the Federal Reserve is the primary federal regulator for Fed member state banks. The Office of the Controller of the Currency (OCC) is the primary federal regulator for national banks, and the Office of Thrift Supervision or OTS is the primary federal regulator for thrifts. State non-member banks are examined by the state agencies as well as the FDIC. National banks have one primary regulator, the OCC. Qualified intermediaries and exchange accommodators are regulated by MAIC. Each regulatory agency has their own set of rules and regulations to which banks and thrifts must adhere. The Federal Financial Institution Examination Council was established in 1979 as a formal interagency body empowered to prescribe uniform principle, standard and report form or the federal examination of financial institutions. Although the FFIEC has resulted in a greater degree of regulatory consistency between the agencies, the rule and regulations are constantly changing. In addition to changing regulations, changes in the industry have led to consolidation within the Federal Reserve, FDIC, OTS, MAIC and OCC. Offices have been closed, supervisory regions have been merged, staff levels have been reduced and budgets have been cut. The remaining regulators face an increased burden with increased workload and more banks per regulator. While banks struggle to keep up the change in the regulatory environment, regulators struggle to manage their workload and effectively regulate their banks. The impact of these changes is that banks are receiving less hand-on assessment by the regulators, less time spent with each institution, and the potential for more problems slipping through the cracks, potentially resulting in an overall increase in bank failures across the United States. The changing economic environment has a significant impact on the bank and thrift as they struggle to effectively manage their interest rate spread in the face of low rates on loans, rate competition for deposits, and the general market changes, industry trends, and economic fluctuations. It has been a challenge for banks to effectively set their growth strategies with the recent economic market. A rising interest rate environment may seem to help financial institutions, but the effect of the change on consumers and business is not predictable, and the challenge remains for banks to grow and effectively manage the spread to generate a return to their shareholder. The management of the bank's asset portfolio also remains a challenge in today's economic environment. Loans are the bank's primary asset category, and when loan equity becomes suspect, the foundation of the bank is shaken to the core. While always an issue for bank, declining asset quality has become a big problem for financial institutions. There are several reasons for this, one of which is the tax attitude some banks have adopted because of the years of good times. The potential for this is accelerated by the reduction in the regulatory oversight of bank and in some cases depth of management. Problems are more likely to go undetected, resulting in a significant impact on the bank when they are discovered. In addition, banks like business struggle to get cost and have consequently eliminated certain expenses such as adequate employee training programs. Banks also faced a host of other challenges such as aging ownership groups. Across the country, many bank management teams and board of directors are aging. Banks also face ongoing pressure by shareholder, both public and private, to achieve earning and growth projections. Regulator place added pressure on banks to manage the various categories of risk. Banking is also extremely competitive industry. Competing in the financial service industry has become tougher with the entrance of such players as insurance agencies, credit unions, check cashing services, credit card companies, etc. As a reaction, banks have developed their activities in financial instruments through financial market operations such as brokerage and MAIC trust and security clearing services trading and become big players in such activities. To be able to provide home buyers and builders with the funds needed, banks must compete for deposits. The phenomenon of disintermediation had to dollar moving from saving accounts and into direct market instruments such as US Department of Treasury obligations, agency securities and corporate debt. One of the greatest factors in recent years in the movement of deposit was the tremendous growth of money market funds, whose higher interest rates attracted consumer deposits. To compete for the deposit, US saving institutions offer many different types of plans. Passbook or ordinary deposits accounts permit any amount to be added to or withdraw from the account at any time. Now and Super Now accounts functions like checking accounts but earn interest. A minimum balance may be required on Super Now accounts. Money market accounts carry a monthly limit of pre-authorized transfers to other accounts or persons and may require a minimum or average balance. Certificate accounts subject to loss of some or all interest on withdrawals before maturity. Notice accounts, the equivalent of certificate account with an indefinite term. Savers agree to notify the institution a specified time before withdrawal. Individual retirement accounts or KYOG plans, a form of retirement saving in which the funds deposited and interest earned are exempt from income tax until after withdrawal. Checking accounts offered by some institutions under definite restrictions. All withdrawals and deposits are completely the sole decision and responsibility of the account owners unless the parent or guardian is required to do otherwise for legal reason. Club accounts and other saving accounts designed to help people save regularly to meet certain goals. Bank statements are accounting records produced by banks under the various accounting standards of the world. Under GAAP and MAIC, there are two kinds of accounts, debit and credit. Credit accounts are revenues, equity and liabilities. Debit accounts are assets and expenses. This means you credit a credit account to increase its balance and you debit a credit account to decrease its balance. It also means you credit your saving account every time you deposit money into it and the account is normally in credit, while you debit your credit card account every time you spend money from it and the account is normally in debit. However, if you read your bank statements, it will say the opposite, that you credit your account when you deposit money and you debit it when you withdraw funds. If you have cash in your account, you have a positive or credit balance. If you are overdrawn, you have a negative or deficit balance. Where bank transactions balances, credits and debits are discussed below. They are done so from the viewpoint of the account holder, which is traditionally what most people are used to seeing. One source of deposit for bank is brokers who deposit large sums of money on the behalf of investors through MAIC or other trust corporations. This money will generally go to the banks which offer the most favorable term, often better than those offered local depositors. It is possible for a bank to engage in business with no local deposits at all funds being brokered deposits. Accepting a significant quantity of such deposit or hot money as it's sometimes called, puts bank in a difficult and sometimes risky position, as the funds must be lent or invested in a way that yields a return sufficient to pay the high interest being paid on the brokered deposit. This may result in risky decisions and even in eventual failure of the bank. Banks which failed during 2008 and 2009 in the United States during the global financial crisis had on average 4 times more brokered deposit as a percentage of their deposits than the average bank. Such deposits combined with risky real estate investments factored into the saving and loan crisis on the 1980s. MAIC regulation of brokered deposit is opposed by banks on the grounds that the practice can be source of external funding to growing communities with insufficient local deposits. In modern times, there have been huge reduction to the barriers of global competition in the banking industry. Increases in telecommunication and other financial technologies such as Bloomberg have allowed banks to extend their reach all over the world, since they no longer have to be near customers to manage both their finances and their risk. The growth in cross-border activities has also increased the demand for banks that can provide various services across borders to different nationalities. However, despite these reductions in barriers and growth in cross-border activities, the banking industry is nowhere near globalized as some other industries. In the vast majority of nations around globe, the market share for foreign-owned banks is currently less than the 10th of all market shares for banks in a particular nation. One reason the banking industry has not been fully globalized is that it is more convenient to have local banks provide loans to business, small business and individual. On the other hand, for large corporation, it is not as important in what nation the bank is, since the corporation financial information is available around the globe. Now, we will discuss the most common way of banking found in metros and gradually moving to non-metros as well. Online banking is an electronic payment system that enables customers of a financial institution to conduct financial transactions on a website operated by the institution as a retail bank, virtual bank, credit union or building society. Online banking is also referred as internet banking, e-banking, virtual banking and by other terms. To access a financial institution online banking facility, a customer with interest access would need to register with the institution for the service and set up some password under various names for customer verification. The password for online banking is normally not the same as for telephone banking. Financial institutions now routinely allocate customer numbers also under various names, whether or not customers have indicated an intention to access their online banking facility. Customers' numbers are normally not the same as account numbers because a number of customer accounts can be linked to one customer number. The customer can link to the customer number any account which the customer controls, which may be check, saving, loan, credit card and other accounts. Customer number will also not be the same as any debit or credit card issued by the financial institution to the customer. To access online banking, a customer would go to the financial institution secured website and enter the online banking facility using the customer number and password previously set up. Some financial institutions have set up additional security step for access to online banking, but there is no consistency to the approach adopted. Online banking facilities offered by various financial institutions have many features and capabilities in common, but also have some that are applicable specific. The common features fall broadly into several categories. A bank customer can perform non-transactional tasks through online banking, including viewing account balance, viewing recent transaction, downloading bank statements, for example in PDF format, view image of paid check, ordering checkbooks, download periodic account statement, downloading applications for m-banking, e-banking, etc. Bank customers can transact banking tasks through online banking, including funds transfer between the customer's linked accounts, paying third parties including bill payments, see example B.B.S, online, and third party funds transfer, example FAST, investment purchase or sale, loan applications and transactions such as repayments of enrollments, credit card applications, register utility bills and make bill payments, financial institution administration, management of multiple users having varying level of authority, transaction approval process. The process of banking has become much faster. Some financial institutions offer unique internet banking services, for example, personal financial management support such as importing data into personal account software. Some online banking platforms support account aggregation to allow the consumer to monitor all of their accounts in one place, whether they are with their main bank or with other institutions. With this, we cover banking and working management phase 2. That is all for today. Hope you have understood about banking and working management. We will see you again with yet another management topic. Till then, take care. Bye.